Wintry Wonderland here in Central Iowa. I'm Business Development Specialist Jason Parkin here at Compass Financial Services. We're on Westtown Parkway in West Des Moines. I'm joined by advisor Justin Van Houten today, and we're going to talk about something that people have probably heard about in the news here and there, and it's something called the Secure Act. And what is that all about?
Yes, so the Secure Act was signed into law at the end of 2019, and it has already taken effect as of January 1st, 2020. And it's the first major piece of retirement legislation since 2006. So kind of a big deal.
One of the things they talk about in there is something called an RMD. And what does that stand for and what does that mean?
Yes, so required minimum distributions. These apply to retirement accounts where you've made pre-tax contributions. So think your traditional IRA, a rollover IRA, maybe a 401k, 403b.
Okay.
So it does not apply to accounts where you've made post-tax contributions.
Okay.
So if you're thinking about like an individual non-retirement account,
A Roth.
a Roth IRA, a
Right.
joint account.
Okay.
So
This is pre-tax.
Yep, this is pre-tax.
Okay. And that's what it talks about. And one of the things it talks about is the age at which that can happen, right?
Yes, exactly. So prior to the Secure Act, the age where required minimum distributions started was age 70 and a half.
Okay.
And now they've changed that to age 72. And so if you're wondering where that line is drawn, if you were age 70 and a half in 2019, the old 70 and a half rule still applies to you.
Okay.
So you'd need to take your RMDs at age 70 and a half for these types of accounts. Now, if you were not yet 70 and a half in 2019, then now it goes to 2020, and now the age 72 rule applies to you. So you would start taking your RMDs at age 72.
So the RMD thing is really the government's way of saying, hey, we want our tax money from these funds. We're going to make you start taking them out rather than sitting on them until you're 80 or 90.
Yep, exactly right.
Okay. There's another part of this act, something called a stretch provision, and this has changed as well.
Yes, it has. So the stretch provision applies to inherited retirement accounts where you would have to take an RMD.
Okay.
So an example might be, say, a parent or a grandparent passes, and so you're inheriting their IRA. When you do that, traditionally you were able to stretch it out over your life expectancy. So the IRS has life expectancy tables they use to calculate that. So you might be able to stretch that out over 15, 20, even 30 years.
The advantage of that would be you'd pay less in taxes because you're stretching your receipt of that money out a longer time period.
Right. A lesser impact from a financial planning perspective, as well as a tax impact, even potentially tax brackets. And now what they've changed with the Secure Act is now you no longer have that stretch provision. Now you have to make those distributions in full within 10 years.
Okay.
So now you're taking that same pool of money you may have inherited that before you could stretch out over 15, 20 plus years, and now you're only stretching that out over a 10-year period.
Okay.
So there's definitely impacts to financial planning as well as your tax planning, once again, maybe your tax bracket.
There are other parts of the Secure Act, and if you're getting close to that age where you start to have questions about this, we've got more information on our website, and you can find that at compassiowa.com. If you have questions, we offer a free hour here at Compass. You can call us at 515-327-1020. Justin, thanks a lot.
Yep, thank you.